And let's turn to what's happening in the markets as we continue to bring you more earnings coverage. Our next guest thinks this is one of the best earnings seasons we've seen in recent years, nearly an 84% beat rate among the S&P 500. For more, we're joined by Mike Dickson, head of research and quantitative strategies at Horizon Investments. Mike, thanks very much for joining us.
Absolutely. Thanks for having me.
It's a good year. Can it be too good of a year?
Well, like you were just saying, I mean, this earnings season, we just have to take a step back and look at the data, and it's not over yet. You know, we do have some of the retailers over the next 2 weeks that's going to give us a pretty good read on the consumer, certainly helpful in the absence of a lot of economic data here in the States. And of course, we get Nvidia. That's also a big one. But where we are now, you know, 90% of the way through with the S&P 500, as you mentioned, 84% beat rate. I think one of the most important things is looking at the top line growth. We saw an inflection a good bit higher this quarter, 8-9% on revenue growth year over year. That's one of the highest beat rates on the top line that we've seen in recent years. So that's going to be the real engine to that bottom line. And the bottom line is also strong, coming about 12% year over year earnings growth for the broad market in aggregate. And it's not just the large caps. You've seen other areas of the market participate as well. And so it's just really been the earnings season that we hoped for, and companies really delivered thus far.
And with what's ahead, the ones we're waiting for, Nvidia, you mentioned some of the retail. What might put a damper on that?
Look, I mean, Nvidia at this point has really become a macro event in and of itself. Certainly, the tip of the spear as it relates to the AI theme that has been driving the market. So that's going to be very important, of course, to see what their demand looks like. And I think most importantly, one of the things we're looking for there, and just otherwise in a lot of the AI discussions, it's been pretty obvious that power demand is going to be probably more of a constraint than Nvidia chips at this point. And so it'll be really interesting to continue to see what they say and other companies alike that are a lot of those AI hyperscalers, what they're going to say about that power demand and how they're going to meet those needs. In Canada, for example, we saw Camco had a pretty big announcement just a couple weeks ago in their partnership with Westinghouse and Brookfield. We're going to need to see more developments like that of how this energy demand is going to be met. I think it's going to be really the next leg of the trade we're going to be looking for, certainly with that AI theme. And then, of course, we hope to see good news from the retailers, which we'll get a lot of that just in the next week or two as well.
And what are we expecting with retailers? You're hoping for good news. A lot of people are worried about that, the consumer.
Well, I mean, there's been some headlines. I mean, even out today, there's concerns around margins and and a lot of the Black Friday sales. But look, we need to also take a step back. We haven't had a lot of consumer-focused data here in the States, over the past 35 days or so. But what we have seen, from prior to that, and there has been some data to point to, the consumer is in a really, really good and healthy starting place. I mean, something that didn't make headlines, earlier this week, the New York Fed puts out, a quarterly debt and credit report. And the reason you didn't hear headlines about it is because things look really good there. So no alarms from, extended, credit concerns like we saw just a few weeks ago with some of the regional banks here in the U.S. So the consumer's in a really, really healthy spot. Debt is not a concern and not inflecting higher. And I think that's going to be the grounds that we're going to want to see as we head into obviously a really busy holiday season where a lot of the retailers really ramp up sales. But we're going to get to hear from them in just a couple weeks and get a lot of that data on the ground. But the starting place is really good, and so I think what we hope for there is what we've seen thus far through earnings season, and that's really strong momentum.
All right, and how are you positioning yourself right now? Where are you looking?
Well, given the top line growth that we've seen, and you take just the top of the market, that top line growth, just with the AI hyperscalers has actually, inflected higher. A lot of that top line growth for, the top of the NASDAQ there, about 15% year over year. And that's up from coming into the year of about 10% year over year. So you've seen an inflection higher in that revenue growth on the momentum side of things. But valuations, believe it or not, in the Mag 7 and otherwise are flat to even down. So you have a really attractive setup where fundamentals are driving the top of the market. I do believe at this point, you can't afford to be underweight those kind of AI hyperscalers. I don't necessarily think it's an add at this point, but I do think you need to maintain exposure. But then I also think there's a couple of other interesting areas. The small mid-cap space I think also has a number of catalysts working in its favor. They also had, tremendous, bottom line and top line growth in line with the large cap areas of the market. And the small cap space has actually seen valuations down 5 or 6% on the year. So good, attractive entry point there. And I think there's a couple contrarian sector plays out there. Healthcare is one of them that I'll throw out that I really like right now, as you've had a lot of the regulatory hurdles largely digested by those markets. Yet they also saw top line revenue growth from a sector perspective only behind tech, here in the U.S. And that has been, a perennial underperformer for the last 1 to 3 years. So I think really attractive entry point there with healthcare, given that it has not participated in a lot of this rally, but the fundamentals seem to be inflecting higher there as well. So I think there's a couple of ways to, kind of add onto that top of the market exposure for some, tactical opportunities as we head in here to the just finish out the year.
Okay, and just going back quickly, one last question about the small caps. Any particular small subsectors of that you like more than others?
Yeah, overall, I like, a lot of the industrial space in the small mid-cap, areas of the market. I think as we look for, again, kind of that, AI trade to continue to mature, and you have that build out of the AI infrastructure necessary to make sure we get the most out of a lot of that CapEx spend, you're going to see some of the more cyclical areas of the market on the industrial materials side of things, I think, be poised very well to benefit from that. And so when you look in the small mid-cap space, players in those sectors will kind of give you a little bit of that value cyclical tilt to offset the top end of the market, but at the same time, still benefit from a lot of the CapEx spend that we have seen, announced just over the last several months.
Okay, Mike, thanks very much for joining us.
Absolutely. Thank you.
Mike Dickson is head of research and quantitative strategies at Horizon Investments.